Hi, this is Bennett Tchaikovsky, and welcome to Inventory Part 4, Entries from a Seller's Perspective. This is my disclaimer and copyright notice. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. Any company names or references to publicly traded or well-known privately held companies that are used in these presentations are the trademarks and or copyrights or for these respective companies. And this presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're going to be dealing with entries from a seller's perspective, and we've already looked at kind of for a buyer or a purchaser of inventory when they returned items or they would receive discounts or allowances. They would typically credit inventory for those purchase discounts, returns, and allowances. However, we're going to be doing things differently from the seller's perspective. When they record these items, we're going to be using contra revenue accounts. And this is going to be the reason why we do this is we need to show we can't really directly debit sales revenue when we have sales discounts, returns, and allowances. We generally leave the sales revenue as it is, and then we're going to be using these contra revenue accounts to reflect any types of discounts, returns, and allowances for a seller. So here we've got our initial sale. On October 1st, 2020, YYZ sells LAX 4,000 inventory parts at a cost of $30 each, with terms to 10 net 30 on account. The inventory cost YI $12 each, and the inventory was sold FOB destination, and LI received those parts on October 5th. So we're asked to record the general entry, and I'm just going to go ahead and also do the T accounts as well. So the amount of sales I'm recording, remember it's the ERDC. The amount of sales I'm going to record is the 4,000 inventory parts at a cost of $30 per part. So the total amount of revenue I'm going to be recognizing is going to be $120,000. For every credit, I need a debit. I'm going to be debiting accounts receivable for $120,000. At the same time, when I'm recording a sale, remember going back to that very first video when we were talking about the Costco example, I also have to show that inventory going off of my books. And so here, the 4,000 parts I sold cost me $12 each. So I'm going to be crediting inventory because my inventory is decreasing for $48,000, and I'm going to be debiting cost of goods sold, which is really that expense that relates to the sale. Again, if you're not really familiar with this transaction, go back and take a look at my very first video in the series, and it'll probably give you a better perspective. So the way we're going to do this is to actually record the journal entry. If it was sold FOB destination, we're going to be recording the sale when the parts are actually received by the buyer, which was on October 5th, 2020. And the way we're going to do this, again, making sure to indent our descriptions. We're going to be showing accounts receivable, or I should say indenting the accounts that we're crediting. AR is a debit for 120. We're crediting sales for 120, debiting cost of goods sold for 48, and crediting inventory for 48,000. So this is going to be the general journal entry we will be using whenever we are selling items. If these had been sold FOB shipping point, then what we would have done is we would have been recording the transaction on October 1st when the goods were actually shipped. However, since this was done FOB destination and they received the parts on October 5th, that's when title transfers. So again, there's a previous video that goes through this, and I would just go ahead and check that out if you're kind of confused as to the FOB shipping point or destination. Okay, so now we've got a sales return, okay? And so previously when we did this for a purchaser, we would debit accounts payable, and we would be crediting inventory. This is different. This is from the seller's perspective. So on October 6th, they returned 300 parts to us for full credit. So we get back 300 items. So we've got to do two things kind of similar to this. When we have a sales return, we have to show two things happening. One, we're getting the inventory back. And that inventory had cost us $12 per part times a 300 or 3,600. And at the same time, LI is giving us these items back. They don't want to pay for them. So I need to decrease my accounts receivable by the 300 times the 30, which was my sales price per part, right? So right up here, that's what I had sold it to them for. So here I'm crediting accounts receivable for 9,000. Now, normally we would be thinking, okay, if I'm fully reversing this transaction, right? So here I had AR to sales, cost of goods sold to inventory, and it kind of looks like so far we're reversing everything. We're debiting inventory, we're crediting cost of goods sold, we're crediting AR, but we cannot debit sales. Rather, what we have to use is we have to use sales returns, which is what we call a contra revenue account. Why do we call it contra revenue? Because it has a debit balance, right? Remember, DCER, right? We record revenues with credits. It's going to be a contra revenue account, so we're going to be recording that with a debit. So, and we'll see a little bit later how sales returns is reflected on our multi-step income statement. So when it comes down here to the journal entry, this is essentially, we're taking those T accounts that we just wrote up there and we're going through and translating it. We're adding that date and the description. And remember, whenever we're crediting an account, we have to make sure we indent. Right over here, debiting inventory, crediting cost of goods sold. So this is what happens when inventory is physically returned to us, or a sales return. Now, the next one is a sales allowance. And this, we could give a sales allowance because you had a great customer. Maybe we say, hey, keep the inventory. We'll just give you a little bit of a credit back on your statement. So from the sales transaction that initiated on October 1st, on October 7th, YYZ is giving LAX Inc. a $3,500 sales allowance for being a great customer. So again, a sales allowance is similar to a sales return. However, the inventory is not physically coming back. So we have to credit AR because now that's going to be $3,500 less that the customer has to pay me. But we're going to be debiting an account called sales allowances, which again, similar to sales returns, we're going to be using our sales allowance, which again is another contra revenue account. It's part of that income statement, that multi-step income statement we're going to be looking at in just a moment. And it's essentially going to be going through and reducing our sales, but we cannot debit sales. We have to debit sales allowances, sales returns, or sales discounts. So here's the journal entry that I used basically to record that sales allowance given to LAX Inc. Okay. And so lastly, from the sales transaction on October 1st, on October 9th, LI is paying us the remaining balance. Yeah, we're getting paid early. So since they're paying within 10 days, and it's really important to remember, right? This 210 net 30 means that if they pay within 10 days of October 1st, right, then what's going to happen is that they're going to be eligible to take that discount, okay? Now, some of you might be saying, hey, Tchaikovsky, you know, is it 10 days from October 1st or is it 10 days from when we actually recorded the transaction? The answer is it depends. It's going to depend on the contract. So you'd have to actually look at the agreement. In this case here, they are paying it literally within 10 days of October 1st, so we're good to go. But if you had a different scenario, depending upon, well, it's 10 days from when you actually receive the goods or when you actually record the sale. But again, we're just going ahead and doing it this way. So since LI is paying though within that 10 days, they are entitled to take a 2% discount on the balance owed. Because again, 210 net 30, 2% discount if they pay within 10 days. Again, take a look at the other video if this does not make sense. So the first thing we're going to need to do is to figure out how much does LI owe us? Well, we had an initial sale, and I totally just screwed this up. So our initial sale is on 10/5. Okay. Wow, good catch, Tchaikovsky. Okay. So we had our initial sale on October 5th of $120,000. Then we had a sales return on October 6th. We had a sales allowance on October 7th. Remember, these things here, again, we credited AR for that sales allowance. We credited AR for that sales return. So when we're looking at this here, the actual amount owed to us is $107,500. And so when we do this discount, so the total amount owed is $107,500. Again, that's $120,000 less the sales return, less the sales allowance. So the amount of the discount that they can take is going to be 2%. Remember that 210 net 30. 2% of $107,500 gives me a total discount here of $2,150. So the amount of cash I'm going to be receiving is going to be $105,350 or $107,500, which is the amount owed less the discount that they're taking, or $105,350. And very important, right? So similar to sales returns and sales allowance, we do not debit sales to record the sales discount. Rather, we're going to be debiting sales discounts, which is a contra revenue account and part of our income statement. Again, we're going to see how that contra revenue account works in terms of the multi-step income statement. It'll be exciting. It's building up to that climactic conclusion. Okay, so how do we go through and record this cash being collected? So they're paying us $105,350 of cash. We're going to be crediting accounts receivable for $107,500. So remember, when they pay us the amount within the discount period, we're crediting AR because they no longer owe us that amount. So we're crediting accounts receivable for $107,500. We will be debiting sales discounts for $2,150. Then this is what it would look like in terms of the journal entry form. I'm debiting cash for $105,350, debiting sales discounts, and then crediting accounts receivable. So when we look at this whole thing in terms of the multi-step income statement, if I were just to look at it for this transaction again, and this is how it would look, and I would go back to that financial statement of the Home Depot, just to kind of take a look to see how that's sold, how that was reflected. So I've got YYZ income statement now. Instead of doing a single step income statement, we're doing a multi-step income statement. And this is a partially prepared multi-step income statement. So here we have sales of 120,000 less sales returns, the 9,000 we had, less sales allowances, that $3,500 I gave them, less the sales discounts of $2,150 gets me to net sales, or 120 minus 9 minus 3,500 minus 2,150, less my cost of goods sold of 44,400. Now, how did I get that number? Well, if I go back here and I take a look, my initial cost of goods sold was for $48,000. However, when I had the return, I credited cost of goods sold for $3,600. So over here, I'm going to have 48,000 less 3,600 for the return on October 6th, gives me total cost of goods sold of 44,400. This gives me my gross profit. Does that mean disgusting profit? No, it just means what is that profit that I made on selling my inventory? It is extremely important for an investor to know that, how am I, for a retailing company, how am I doing in terms of marking up my inventory? Do I have a good margin on it to cover all the other costs I have as a business? So I want to thank you for joining me here today on this video journey. Please do not forget to like and subscribe, and I look forward to seeing you on the next video. Have a great one.